Good morning, everybody. Welcome to this manufacturing management webinar with Inenco. My name is Chris Beck. I'm the editor of Manufacturing Management. I'm delighted today to be joined by Jordan Rassas, Head of New Business at Inenco. We're going to be talking about something that I'm sure is dominating your thoughts, everybody who's watching's thoughts, as well as everybody who's not watching. It's the kind of big topic at the moment. It's rising energy prices, and Jordan's going to be explaining some of the ways that the manufacturers can mitigate against those rising costs. Hi, Jordan. We'll just start. There's I think a quick agenda that you'd want to show. We're going to turn our cameras off in a second, but also if you've got any questions for Jordan, there is going to be some time at the end for a Q&A. You should see a Q&A box on your screen on the right hand side. Just pop a question in there, and we'll work through them at the end as we go. But brilliant. Okay, over to you, Jordan. A quick agenda, and we'll go from there.
Excellent, thanks. And hello, everyone. Just to introduce myself properly again, so my name's Jordan Rassas, the Head of New Business at Inenco, and I've been in the energy industry now for 11 years. 8 of those years have been served with Inenco, and I've been always in the prospect-facing space. So I've been delivering energy procurement solutions to large energy users for a vast amount of time. Let me just try and share this screen with me. So just let me know when those have loaded up correctly, Chris, please.
Yeah, all good.
Brilliant. So in terms of today's agenda, a very, very quick introduction to Inenco, just to set the scene and tell you all about who we are and why we're giving out the information that we are. We'll then going to start by talking you through the market, so give a comprehensive market update, so what's actually happened in order to get us to where we're at today. I'll look through the historical situation, so how is today's market different to what potentially people are used to, maybe historically over the last 2, 3 or 4 years, and then I'll look forward to what the potential solutions might be as well, with a view to questions at the end.
So yeah, Jordan, could you give us a quick intro to who Inenco are?
Yeah, absolutely, Chris. So to start with, I always start by introducing Inenco as the oldest energy consultancy in the country. And I think why that's really important and relevant now more than ever, we were active, throughout the Middle Eastern wars of the 70s, the miners' strikes of the 80s, the market deregulation of the 90s, and much of our procurement team were actually in place throughout the 2008 financial collapse. So it gives us a really unique insight that there doesn't tend to be much that has happened or can happen in the energy markets that we haven't seen before. And to date, as an organisation, we trade in excess of £5.4 billion worth of energy, and that's all traded in-house, and that's all traded from our head office in Lytham.
Sure. Yeah. And as I said, energy is a huge topic at the moment. What's the kind of current state of the market? What's going on at the moment?
Sure. So to start with, you all see a picture of the graph there, and it looks very bleak. It doesn't paint a particularly pretty picture. And in terms of explaining what's happened, the long and short of it is, Chris, we've gone into this situation where we're currently looking at the highest price for energy that, record highs, the highest price for energy that we've ever really seen in the history of the world. And just 18 to 24 months ago, we were at record lows. So I think it's been a bit of a double whammy, for want of a better phrase, for a lot of businesses. And in terms of what's actually happened, you may recall that around the start of 2020, not only was COVID announced, which caused the world, certainly the Western world, to go into a lockdown, but also oil was trading so low that people were being paid to take delivery of oil on short-term contracts. So combination of oil prices being low and demand being at, globally lower than ever levels meant that throughout 2019 and 2020, energy prices were actually the lowest they'd been. What then happened was, towards the back end of 2020, more particularly, the Southern Hemisphere countries started a manufacturing push. particularly Southeast Asia. They were manufacturing at unprecedented levels. And as a result of that, what they were doing is they were buying all of the available LNG that was out there in the market. They were effectively setting a price for LNG in the market that Europe didn't really want to entertain. And at the time, in fairness, it was felt that Europe didn't really need to entertain those LNG prices. And that was largely down to the fact that there was going to be a pipeline that was going to be coming from Russia and into Western Germany. That was going to be called Nord Stream 2. What we saw, though, throughout 2021 was Nord Stream 2 was delayed, ultimately up until the point where it was called off. Now, where the issues started appearing, Chris, was actually around about May, June time, 2021, which is what we'd call gas injector season. Mm-hmm. And the reason we had issues was typically at the end of winter, start of summer, the gas injectors will look to the market. They'll look to buy all of the available gas to put into storage so that when the winter comes, we're protected from volatility. Unfortunately, however, what happened this time around, as I mentioned, all of the LNG was going to Southeast Asia at unprecedented rates that Europe didn't want to entertain. And Nord Stream 2 was delayed to the point where it was then cancelled, which meant that the market, and this isn't a Russia-Ukraine thing. I often split the market update into two parts and remind people that actually, as we were in December last year, so still 2 months ahead of the conflict in Russia-Ukraine, we'd already hit record highs. And that was as a result of gas injectors not being able to find the gas to put into storage unless they wanted to pay the record high LNG prices. Nord Stream 2, which was the saving grace, then got cancelled. And effectively, in terms of the second half of the tale and what's happened since then, there's been this real short-term volatility increase particularly since the end of February when the Russia-Ukraine situation kicked off. And why that's had a major impact now is that a market that was already struggling from a gas storage perspective, in Europe imports 43% of its natural gas from Russia, or it did. So a market that was already struggling and that was already at record highs, now all of a sudden needed to switch its focus to the security of supply. If we stop taking oil from Russia, we can get that from elsewhere. But what happens with the gas? So then what's then happened since, and what we found since the Russia-Ukraine situation has escalated, is that a market that was already at record highs has now not only continued upwardly rising, but has now gone into disarray in terms of contract options, suppliers that are able to work with clients, and the ability to even get into contract in the first place. It's certainly not been helped by Nord Stream 1 going offline several times over the last few months, and it's offline as we speak, and LNG fires at various different facilities have just meant that, for want of a better phrase, Chris, it's become a bit of a perfect storm. But the key takeaway here is we were already at record highs, in advance of the Russia-Ukraine situation escalating, and it was largely apparent that it was down to gas storage.
Sure, yeah. Scary year and a half or so, like you say. But what were companies paying historically?
Sure. So in terms of the historical breakdown of an energy bill, now, before I load up the next slide, just pay attention to this sort of low bar here, because most organizations I talk to, most non-clients of Inenco are coming to the end of maybe 3-year contracts, 2-year contracts, in some cases 4 or 5-year contracts. And the first thing to mention before I move off this slide is they were often taken out when the commodity element was trading at a rate that was down here. So for electricity, what most business will have found is if they signed a contract in 2019, 2020, which is expiring now or shortly or next year, what they'll find that back when they signed that contract in 1920, particularly if that was a fixed price contract, which is what we're seeing a number of organizations coming out with at the minute, is that they'll have probably struck a commodity cost of around about 4 or 5 pence or 40 to 50 pounds per megawatt. The non-commodity element, this changes. I mean, this could have been anything from 7, 8, 9 pence per kilowatt, but most organizations will have been used to historically paying anything from 10 to 12 or maybe as high up as 15 pence per kilowatt fully delivered. And that would have been made up of, again, historically around about 6 or 7. Again, that could have been 8 or 9 pences of non-commodity, but the commodity element, which was the stickler, would have typically been about 4 or 5 pence per kilowatt.
Sure, yeah. And what's the situation today?
Okay, so from a non-commodity perspective, there's been slight rises, but that's not where the damage has been done. That's largely around the same mark. However, from a commodity perspective, and I'll explain these prices and how they make sense shortly, but from a commodity perspective, that 40 to 50 pound per megawatt is now, it's nowhere near 40 to 50 pound per megawatt. And what you see here is effectively yesterday's market report, so the 5th of September's market report, which shows the close of play on Friday's market prices. And the first thing to mention or to explain, and again, apologies if I'm going over old ground for any of our viewers here, but I want to make sure that we cover off everything in detail. So the first thing to explain is that energy is typically traded in seasons. So the prices I'm showing you here are the future curve, the seasonal prices. So most businesses will renew, Chris, on either the 1st of October or the 1st of April. Now, the reason for that is the 1st of October is the season of winter. So that runs from the 1st of October right through to the last day of March. And the 1st of April is the season of summer. So that runs from the 1st of April right through to the last day of September. So if a business is taking out a 1-year contract, historically, and the way the industry is, the majority of businesses are aligned to either starting on the 1st of October or the 1st of April. So what these prices show is effectively the close of play price on the 2nd of September, and these are in pounds per megawatt. And again, this is just the wholesale element of electricity only, so it's not the fully delivered, it's just the wholesale rate. But this, again, for perspective, in 1920, on the graph that I showed you earlier on, will have been around 40 to 50 pounds per megawatt. For someone looking at energy to be delivered on the 1st of October 22, well, as of close of play Friday, this was trading at £631.31. So, a huge increase, in excess of 10 times the increase there. For summer 23, so if someone was looking at a year's worth of energy from the 1st of October, they'd need 6 months worth of winter, 6 months worth of summer. And the summer 23 rate is trading at already £338 per megawatt. So, a mixture of the two for that year is around £450, £500 per megawatt. So about 10 times what businesses will have used to been paying. And I think where it gets, or one point to mention, is that the keen-eyed will notice that the prices actually go down the further out you look. And that's because the market's in a state of what we call backwardation, which effectively means, in layman's terms, the further out you look for delivery of energy, the cheaper it is. And the reason for that is we're not expecting, short-term gas issues to have as much of an impact on prices in 2025. So the market's in this state of backwardation. I think the key thing to mention, though, is as we get closer and closer to these periods, and I speak to businesses every day that thought they were protected because they had an October 2023 renewal, that's already trading at £361 per megawatt. And the closer we get to that period, the probability is, if all of this continues, that rate will continue to increase, which is what we saw with winter 22.
Yeah, brilliant. Thanks for that overview. It's a really interesting one, Jordan. But if we move on to a kind of more practical side of things now, I suppose, if I was a high energy user, and many of the people, if not all of the people watching today will be, what are some of the steps, and what are some of the kind of things that they could be doing?
Sure, absolutely. So again, I'm going to apologize if I'm going over old ground for any of our viewers, or talking around some of the knowns to some of our viewers. But I think the first thing to explain, and there is no right or wrong way to buy energy, Chris, but there are two very different markets. So there is the retail market and the wholesale market. And in terms of explaining, because you might be, if you're a viewer sitting there thinking, I don't know if I'm on the retail, I don't know if I'm on the wholesale. Typically, the retail market is one where a client will, either through a broker or directly with suppliers, they will ask a supplier on a given day for a fixed price for a fixed amount of energy. And that price, as I said, will be fixed. It normally gets given to the clients at around 10 or 11 in the morning. They get until 4 p.m. that day to make a decision. So there's two different markets. And the first thing I wanted to explain before going into the solution is why the retail market in particular has hit this stage where many people feel like it's broken. And that's largely because when you look at the typical makeup of an energy bill, typically, given how much the commodity element has risen, on a typical electricity contract, the vast majority of that bill now is the commodity element. As we mentioned, businesses will have 40, 50 pence per kilowatt commodity element, maybe 10 pence per kilowatt non-commodity element. So the big part of the energy bill is the actual the commodity, so the raw electricity that powers the business. You then tend to find about 15% is taxes and levies, 10% is transport and distribution, which leaves about 5%, which is the supplier margin, of which only about 1% is the supplier profit margin, which actually scares or shocks most people. So I guess the problem with the retail market, Chris, in today's world is the minute a customer goes to a supplier and asks for a fixed price. So for example, I'm speaking to many businesses at the minute who are at a wall. They just can't get fixed price offers from suppliers, even the same suppliers that they've used for years and years. And the issue is the minute you decide to ask for a price, you're committing to a commodity cost. And explaining that a little bit more, energy is a genuine commodity, exactly the same as gold, exactly the same as oil or Bitcoin. You know, there is a genuine cost for energy, and that cost changes, you know, several times, hundreds, thousands of times throughout the day. The problem with the retail market, let's say for argument's sake, at 11:15 on the 6th of September, the customer decides to contact 10 different suppliers and ask for a price. And that might be for 3 years worth of energy to be delivered on the 1st of October this year. The first issue that you've got is in a normal market, you're then committing yourself to nailing that commodity at 11:15 on the 6th of September for the next 3 years. You can't do anything about the taxes and levies at that stage. You can't do anything about the transport and distribution at that stage. So the only thing you can negotiate on the fixed price market is the supplier margin, which is by far and large the smallest portion of the bill. And I guess where that market's got even scarier for a lot of prospects is that the retail market, suppliers just aren't keen to take on clients in that way anymore. And for a number of reasons. The first one is, you know, prices are being pulled back left, right, and center. The market currently is moving up. And it's more volatile, which I'll cover off in later slides. It's more volatile currently than ever before, which means that suppliers will be giving customers prices at 10 o'clock that aren't even relevant again by 11 o'clock in the morning. You've then got the issues around credit. So from a retail perspective, you know, a customer that historically might have spent £1 million on energy and historically might have signed a 3-year contract, might have needed credit for £3 million worth of energy. Now they might need credit for £15 million worth of energy, and the supplier might have concerns around whether they're even going to be still using that energy in 2 or 3 years. So that retail market, you know, as a whole has hit a wall, we feel. So the first thing we would be recommending is the businesses that aren't looking at wholesale energy procurement is to start looking at that. And the main reason for that, Chris, is what wholesale procurement will allow businesses to do is, again, you can't negotiate the taxes and levies or the transport and distribution at this stage, but you will be able to work on the supplier margin. And also the most important part is Inenco works with organizations typically, you know, 12 to 24 months in advance of their current contract ending to find the best possible day to buy the commodity element of the bill. And that is the most important part of the picture at the minute. In terms of the routes and again, how would businesses access the wholesale market? There are a number of different routes and they largely depend on a client's size. So typically, if an organization spends anything from 100k up to say £5 million, then what we would look to do is give them access to wholesale procurement through our portfolio. What the portfolio allows us to do is aggregate clients together in terms of volume. There would still be a standalone supplier contract. You'd still be treated as an individual client, but it just allows that client to then purchase the commodity element of their energy separately, allows that client to access the wholesale procurement market. We'll come on to the strategies shortly. But yeah, that's the option for sort of what we would call the mid-sized energy users. What we then have for the larger users, their route to wholesale procurement might be through Flex. So with Flex, that's typically aimed at a larger organization, typically with an energy spend in excess of £2 million. And with flexible energy purchasing, that's one where there would be, again, access to wholesale market procurement, a completely bespoke strategy tailored to your business. We would tend to, there isn't really an off-the-shelf strategy, which again, I'll unpack more shortly, but we would tend to look at what's going on with the business, what the individual needs are. Is it best possible price? Is it budget certainty? Is it potentially a mixture of the two? And then we would build out a strategy on the back of that. But the long and short of it is, regardless of the client size, we would look to take them onto wholesale procurement. It just depends whether it would be portfolio or bespoke flex.
Great, thanks, Jordan. You mentioned the word strategy a couple of times there, and without getting into too much detail, because I'm sure we could do a whole kind of 3-hour webinar on just that. But could you give an example of a strategy that might work quite well?
Yeah, absolutely. So again, the key thing to mention is within the portfolios, we have 4 strategies. We have the fixed strategy, the cap strategy, the trend strategy, and the prompt strategy. And I'll unpack the cap strategy some more shortly. And then from a bespoke flex perspective, there genuinely, as I mentioned, there isn't really an off-the-shelf strategy. But what I wanted to do today was talk to you around the cap strategy. It's the one that we've felt that businesses, prospects that we've talked to have found that it has been different. It has given them what they've needed in terms of the ability to optimize price, but also that view on budget certainty. So in terms of how the cap strategy works, Chris, again, give an example. If we've got a customer that comes to us or a prospect that comes to us and it's an October 2023 renewal, so we might know that we've got a year until the customer needs to physically start using that energy. What we would do is typically we would work on a 3 or a 5 year basis. So if we were looking at this on a 3-year basis, the first thing we would do is, for argument's sake, if you were a customer today on the 6th of September, the idea behind the cap strategy is it's designed to give, on day 1 of trading, a worst case scenario or a budget, and it's designed to give you absolute protection. So the way it would work, Chris, is on day 1, let's say, for example, you were an October 23 renewal, we would look at the price of energy for winter 23. And for argument's sake, let's say it isn't, but let's say it was trading at 10 pence, just to keep the math simple. What we would do is we would set a cap at 5% above the market on day 1 of trading. We would give you that number to put in your budget, and we would do that for all of the seasons into the future as well. We'd give you that number, we'd say, put that in your budget. That's your worst case scenario. We wouldn't necessarily buy 3 years worth of energy on day 1. What we would do is we would monitor the market. And the benefit of the cap is that, as I mentioned, if the market shoots up and all of a sudden, starts rising, carries on rising, hits the cap, that cap is an automatic buying mechanism. So we would lock out all of the energy that business needs, which is why we were able to give that budget on day 1. The benefit, however, is if the market starts to fall when we've set that cap, then the cap will effectively track the market down. So there'll be a point by tracking the market down, but not back up in the future, that the market will look to intercept the cap. And it's at that point that the traders or that the cap strategy would kick in and that we would make a purchase. So I guess the key takeaway in a nutshell or in layman's terms is on day 1 of trading, they'd look at the market, they'd look at where the prices were at for all of the seasons, potentially 3 years into the future, 5 years into the future. They would set caps on day 1. They'd give the clients them caps, put them in the budget. Your worst case. We're not necessarily just going to hope that the prices come down. We're going to set these caps, which is why it gives the budget protection. And then we'd monitor the market. And again, what we found historically, and again, it's historical anecdotes. Well, it's a bit of a bullseye. Here's what you could have won. But what we found historically is the clients that were on the capped strategy, when you look back to what the market did in 2021, when it started to turn, customers that had 3 years in the capped portfolio, as soon as that market started to turn upwards, their caps were hit 3 years into the future, which meant they were locked out and are often currently paying, still paying 4 or 5 pence per kilowatt for the commodity element.
Great. Yeah. Thanks for that, Jordan. Everybody watching, please keep getting your questions in. We're not far away from the Q&A, so it's a good opportunity to pick Jordan's brains and get a bit of expert opinion. But for now, you've given an example of a strategy there, and you've spoken about a few others. It's obvious that companies need a strategy, now more than ever, I suppose. But when's the best time to look at contracts? Is there a best practice around that?
Absolutely. So I'm going to split contracting and timing up, and I'm going to talk to you around the timing. And for me, the first thing I'll draw your attention to is just these bars on the right of the screen, which is 2020 and 2021. And what this graph shows is the amount of variance within the year. And what you can see is that, electricity in the year 2021 moved over 250%. Gas moved over 200%. That meant that someone looking at the start of the year, someone looking at the end of the year might have genuinely seen a 250% difference in the prices they will have looked at and maybe even achieved, which, as you can imagine, will work wonders or horrors for competitive edge for some manufacturers. So for me, the most important thing is to make sure you've got as much of a horizon as possible. If you've got a contract that's, for example, ending in October 2023, there isn't really any logic in waiting until 6 months before that contract anymore. I think historically business has gotten into a routine potentially of waiting until 6 to 12 months before renewal, looking at what the market was doing, potentially even just signing an extension of current rates. And I think it's potentially those businesses that are getting the biggest shock at the minute. So for me, the first thing I would mention is anyone who's got a contract that's due, I'd say in the next 24 months, I would start looking now, seeing what the available options are from a supply contract perspective, from a wholesale market perspective. Not necessarily buying all of the energy today, but you absolutely need that view on the market so that if something starts to change, as we've seen so often over the last 18 months, you can be in a position to strike.
Great.
And in terms of the contract length, so I guess the biggest question I'm getting asked at the minute is how long do we contract for? Do we contract for 1 year? Do we contract for 5 years? The first thing I would explain, or the first thing I would go back to, is the commodity element of energy. The market is liquid for 5 years into the future. Typically, the market's liquid 5 years into the future. Energy suppliers, again, we're contracting people out until 2027. So what we tend to find, or what we say to organizations, is typically the market moves in cycles. So over a 5-year cycle, there'll be periods where the market, rises to extreme highs. There'll be periods where the market falls to extreme lows. Again, evidenced even in the last 3 years in particular. So for us, the importance is, you must be in it to win it. You've got to, the last thing I would recommend is a customer, when you look at the state of the market, and the market, as I mentioned, is in this state of backwardation, which means the further out you look for delivery of energy, the cheaper it becomes. Effectively, by signing a really short supply contract, by signing a 1-year deal, you're effectively cancelling out all of that future benefit. You're just ignoring it and hoping that the market is going to come down. So for us, the importance is of a long supply contract, ideally 3 or 5 years into the future. And then in terms of the purchasing strategy, you don't necessarily need to purchase 5 years worth of energy. You can then look at what strategies you apply, once you've got that contract put in place.
Great. Thank you very much, Jordan. I think that reaches the end of the presentation. We've got some time. We've got 15 minutes or so for some questions. So please do keep them coming in. I've got a couple here to start with. In fact, we'll start with this new one that's just come in. Should we not enter a contract while prices are so high? That's what it says there, Jordan. Any thoughts on that?
I've been asked that question for at least 18 months. So if I talk about it anecdotally, there were businesses that were reluctant to look at contracts when the prices were at 15p. There were businesses that were reluctant to look at contracts when the prices were at 20p. Businesses that were reluctant when the prices were at 40p. So I guess the first thing I would answer with is, it very much depends on when the contract term is. If your contract's due in potentially 6 weeks or 4 weeks and you're hoping for the market to come down, then I very much wouldn't recommend that. But like I said earlier on, if you've got a contract that's in place, that's got a 2023 or even a 2024 end date, I would certainly look to contracting or look to a solution at this stage, and the strategy that goes behind that in terms of, do you want to be 100% hedged? Do you want to take more of a risk adverse? That can be unpicked at that stage. But for me, no, the high and low of it is, depending on how soon that contract is due. By choosing not to contract, you're effectively betting that the market is going to come down. And when you look at all of the reasons that have led to the market rising, the probability is that it's likely to continue in the short term.
Yeah, we've had a follow-up to that. The person who asked that question has said the contract ends at the end of this month, presumably end of September.
Yeah, so what we've found, and that's going to be, for me, I would very much like to, have a conversation around that offline if the person does want to reach out. I mean, what we've found is it's very much a situational, case-by-case basis. Depending on whether there would be a bespoke flex, we can potentially look to continue the agreement with the current supplier and take over the trade-in. If the client would come to Inenco and based on size would be portfolio, then we would look to, based on the fact that they're only 4 weeks away, 3 weeks away from contract start date, we would need to put an interim solution in place in order to get the contract get the client to our earliest portfolio entry date. So if that client came to Inenco today, we very much wouldn't be waiting. The recommendation would be to look at contracting and to look at contracting ASAP.
Great, thanks. Another question on the capped strategy that you spoke about. How does the cap strategy mitigate the risks posed by poor liquidity?
It's an to be fair, I'll have to take that question offline and go to the traders. We've not seen there be any impact already. I mean, throughout the most volatile periods of market liquidity in 2021, when we look back at November and December last year, which is when the markets first started to realize that, we had this gas storage issue, the customers that were in the cap strategy were very much the ones that were the most protected. In Inenco's historical case studies, that the vast majority were trading to some kind of cap strategy. So ultimately, there's always going to be liquidity in the market at some point. The idea behind being in it to win it is the minute that market turns liquid, if you're in there, we'll make that trade. And that's what we've found with customers that have, for example, let's say in 2020, they did a 5-year deal with Inenco. And then they wanted us to, the minute the market became liquid in 2026, they wanted caps to be put in place. Absolutely. The traders are monitoring the market, every minute of every day. So the minute the market does become liquid, that trade will be made.
Great. Keep the questions coming. We've had another one come in. What if you can't sign for longer than 25 months?
I would, again, offline, I would unpick that question a little bit more. If it's down to potentially a change in ownership, if it's down to it potentially, again, I've had businesses approach me because they were planning on selling the business in 2 or 3 years, then often it's better to sell a business with an energy supply strategy in place. But again, in terms of an off-the-shelf answer for that, it depends on when their current contract expires. If the current contract, again, is a 1st of October renewal this year, i.e. they've only got 3 weeks and they can only sign a 2-year, then I would just be looking to get that contract in place as soon as possible and be running that supply contract as soon as possible. In terms of the portfolio, there won't really be much benefit if we're being completely honest, because that first 1 year, there's not even going to be enough time to trade. And then you're going to get 1 year in the portfolio and then the contract's going to have ended. So we can look at it. Typically, the minimum is for 3 years, largely on the fact that, that will give you the full benefit. But again, it's sort of on an individual basis. I would love to try and unpick that some more.
Sure. Another one. Are you expecting any short-term impacts from the new Prime Minister and the new government?
Yeah, so again, that's probably the question I'm being asked the most at the minute. And what we've found, or what I say is, look, realistically, in the short term, I think when the Russia-Ukraine situation began, the focus changed slightly from, cheap gas in the short term. Now the focus is on how can we ensure that we are independent of Russian gas. So for me, the long and short of it is, in the short term, my thoughts are that any solutions would be immediately aimed at the domestic market, given the political swing that may have. But I think also from a long term, when you look at what the actual views are of the government and what the actual need is of Europe, it is to become less reliant on Russian gas And when you look at how that's going to be made possible, it's potentially going to be increases in renewables, changes to subsidies. So I don't think short term, I certainly wouldn't be banking on that in the short term.
Great. Keep them coming. We've had a couple more. What do you see as future trends? How far in the future can you predict, and how long do you think prices will remain this high?
Yeah, good question. So, it's impossible to predict with certainty anything. It's certainly over the last 18 to 24 months that's shown us that. But I think the answer to the question is, again, when you look at what's caused the issues, lack of gas in storage.
Oh, we seem to have lost Jordan. We'll give him a minute to come back. He cut himself off mid-flow there. That's a shame.
Chris, can you hear me?
There you are. You're back.
Yeah, perfect. So,
start the whole thing again.
So throw the question at me again then, please, Chris.
Yeah, the question was around future trends and how long you think this situation might last.
Yeah, so again, if I was to I'll just start from the start again. So, I mean, the reality of the situation is when you look at what's caused the current pricing situation, lack of gas storage, the LNG that's already going to Southeast Asia on the futures market for potentially 3, 4, 5 years. What I say to clients is there is no silver bullet. Putin isn't overnight gonna pull out of the Ukraine and say, starting from now, everyone's friends. But even if he did, Nord Stream 2, which was the solution in 2021, was still 12 months away from completion. So as a minimum, what we're expecting is that the probability is that the market will stay at this new level, the new normal, for want of an overused phrase. But I think the probability is that pricing will stay at this new level for the next 12 to 24 months as a minimum.
Okay. This is the last one for now, so make sure you get your questions in if you've got something that you want to ask Jordan. We're struggling to understand the vagaries of the energy market. We don't feel like we have the internal expertise and resource to be able to do so. How do we go about understanding, or better improving our understanding of the energy market?
Sure. So I guess, you've started in the right way by joining the webinar. Inenco as an organization recognizes that there is, at the point when it's probably been needed more than ever, there is probably a bit of an understanding out there in the industry around energy, around how contracts even work, how they're put together. Again, a lot of organizations I speak to don't even realize there was a difference between the retail market and the wholesale market. So as a first port of call, I would absolutely, as you can imagine, recommend a meeting with our consultants. That tends to be, in terms of the format of these meetings, it would be an informal sort of gap analysis to look at how you've procured historically. We'll give, again, very comprehensive market update and again going into a lot more detail around the specifics as to what the solutions could be. But for me, I would say attend as many of the industry webinars as possible. Certainly, take a meeting with one of the consultants who'll be able to explain. And I think one of the biggest bits of feedback Inenco has had, and one of the reasons we've taken such a busy online schedule over the next sort of 2 to 3 months, is because the meetings that we have with the consultants and prospects, we tend to go into so much information. It tends to be more of an education process from start to finish. This is how the industry works. This is where we're at. So I would very much recommend that as a starting point. More than happy to speak to businesses out there that are still scratching their heads or still have any questions, or even just want to unpick anything I've said just in a bit more detail.
Brilliant, thanks, Jordan. It looks like we've reached the end of the questions. So thank you very much to Jordan, and thank you everyone for tuning in. Jordan mentioned there that they're doing a lot of online activity, and we've got another couple of webinars coming up with Inenco in the next couple of months. So keep your eyes peeled for those. This morning's session will be available on demand pretty much straight away. So you'll get an email about that as well if you wanted to rewatch anything or pass it on to a colleague or anything like that. Jordan's contact details are on screen now. So if you did have anything that you wanted, we've just had one more question come in. Well done to that person. We'll just quickly do that one. If you've got another couple of minutes, Jordan, do Inenco deal with smaller companies around 12k per year?
Yes, we do. We have an enterprise mid-market division, and we can look to, if the person wants to get in touch, if they just send me an email, my details are there on the screen, as you said, or if they want to find me on LinkedIn, then absolutely I can set up a conversation with the relevant employee internally.
Brilliant. Thanks, Jordan, and thanks everyone who asked questions. Hopefully we'll see you again soon on another manufacturing management webinar. But for now, thank you very much. Enjoy the rest of your week, and we'll see you soon. Thank you all very much. Thanks, Jordan.
Thanks, everyone.